Philippine shares joined most Asian markets decline on Wednesday as better-than-expected China data failed to impress and dispel concerns over Beijing's economic outlook, while traders remained on edge over the intensifying Middle East tensions. The PSE index kicking off from 62.68 this morning. Joining us, Carlo Lim. He's co-founder and CEO of DragonFi Securities. Hi, JC. Welcome back. Good to see you.
Maybe nice to be back. Good morning.
Good morning. All right. I want to start with the Middle East conflict. You know, the market reaction so far to the Israel-Hamas war. What do you think it says about the war? Do you think it's indicating that it thinks it's going to be limited, short-lived, and contained? Is that what you're getting from the reaction of the market?
Yes. I have no special insight regarding the geopolitical crisis, but I think the consensus is that as long as it doesn't broaden out to other participants, that the market should be insulated.
All right. So when you've got stock markets dealing with a lot of uncertainties, from geopolitics to interest rates to earnings, now earnings season, how should one position and how patient should your capital be?
Last we spoke around 2 months ago, I actually made the case of a broadening out that would include the PSEi index, but on account of the headwinds that we face, I no longer subscribe to this notion. I actually sent you guys 2 slides that will give clarity to my forecast and to the current state of the market.
All right, so let's pull up the first graphics. I think you're looking at the performance of, the S&P. Yes, let's take a look. This one. This is the one,
Yep.
right? All right, so
that's the one.
Okay.
So essentially, what I did there was I listed the sectors within the S&P 500 with their year-to-date performances. Then I broke out the PSEi constituents and assigned them to their appropriate sectors. Mm-hmm. Based on this, we can see that the PSEi performance to date is exactly what one would expect. So we have no representation in the communication services and information technology. Actually, Globe, Tel, and Converge are part of a subsector known as telecoms, which is down 13.87%. Although we have standouts such as Bloom and GT Cap in the consumer discretionary space. Bloom only accounts for 1.15%. I'm sorry, it's a free float market cap only accounts for 1.15% of the PSEi. Mm-hmm. Industrial, energy, materials, financials, real estate, consumer staples all perform in line with their US counterparts. Mm-hmm. So in the next slide.
Okay, I think we can turn to the next slide now.
All right. So in the next slide, what I did was I disaggregated the earnings of the PSEi and assigned weights and derived the net income attributed per sector. Mm-hmm. As you can see here, the PSEi is actually over-indexed to the sectors that are disadvantaged by the current macroeconomic backdrop. So this is why I believe that given the current circumstances, I don't see a broadening out occurring.
All right. If we could just go back. So you're saying, for example, that the weight, the percentage of PSEi net income to the sector, we're heavily dependent on financials, for example, 29.6%, real estate, 22%, consumer staples, 11.5%. We're so dependent on these 3 sectors, which are, when you look at the S&P performance, which are the sectors that are not doing so well. When you look at the consumer discretionary, energy, for example, where they're number 4 and number 5, and weighting, for example, in their contribution, those are supposed to be the outperformers if you look at the S&P sector performance year to date. Did I get that right?
Yes, that's correct. So essentially what we have here is really a bifurcation of between interest rate sensitive assets relative to assets that are not reliant on the cost of capital. And the PSEi, unfortunately, belongs to the former rather than the latter. So put yourself in the shoes of an institutional investor. Let's say you need emerging market exposure. And if you look across the PSEi, and it's over-indexed to the sectors that are challenged in this current macroeconomic environment.
Mm-hmm. See, I'm looking at the first slide again. You essentially put in the year-to-date performance of the top stocks that we have, 30 index stocks, I think. Bloom is the outperformer, up 36%, followed by the likes of GT Cap, 29, Meralco, 26. So it's too late to position in these stocks, right? Or is there more runway for a rally to happen?
Not necessarily. Let's say, for example, for consumer discretionary, we're seeing a softening in consumer spending. So I'd be more conservative in terms of my outlook for that sector. But for example, for Meralco, for instance, it's really the narrative that's working right now. It's both has offensive and defensive properties. It has a great balance sheet, and its dividend growth is really high. It has a dividend yield of 5.2% at the moment, in spite of the fact that it's trading at its of its 10-year historical price range.
All right, just wanted to bring in the opening numbers. Actually, the trade for the last 12 minutes of trade for the day, the index is down by 1/3%, joining most Asian peers lower. Really, all shares also down by 1/5. All sub indices are in the red. JC, just one big corporate story for today. BPI firing the opening salvo for the third quarter earnings season, and it's record 9-month and third quarter earnings. Look at that. Net income for the third quarter, 13.5 billion, up 33%. Revenue is up 18%. When you look at the 9-month period, net income is up 26% to 38.6 billion pesos. Just very quickly, do you think this is, a good sign of how things will go, or it's only the banks that are expected to do very well? Everybody else not so.
Yeah, so the banks have been the outperformers, right? So it's BPI along with BDO, and so I expect that net interest margins will be elevated in the future, and this augurs well for the banks.
All right.